Awesome. Well, welcome everyone. This is the first panel of the day, so excited for everyone to be here. This panel is about optimizing your DeFi portfolio. Right here on stage, we have 3 awesome panelists, all building projects in the ecosystem. So I think we can start with maybe a quick round of intros, just to get everyone acclimated on what everyone's building, and go from there.
Hello, I'm Simon. I'm smart contract dev at Vector Finance. For those who don't know us, we're a platform on Avalanche, building DeFi products, so you can have some higher yields on Vector than if you deposit yourself on various platforms. So we're offering yield on various stable coins and large caps like Bitcoins, Ether, and AVAX.
So my name's Dylan. I'm a core contributor at Yield Yak. Yield Yak is, I guess, a bit of an aggregator for the Avalanche DeFi ecosystem. So there's a DEX aggregator that routes your trades through the cheapest route across all the liquidity sources. So it's kind of like a liquidity endpoint. And then we have DeFi strategies a bit similar to Vector, which essentially try to simplify specific DeFi strategies on top of other protocols. So that's like taking a deposit and looping it through a borrowing and lending protocol like Ava or Benki, or it can be an auto-compounding strategy built on top of GMX, decentralized perps platform. And we also have a liquid staking token, so which essentially brings yield from the validator chain, the P chain, and lets you access that in the DeFi ecosystem, the C chain.
Hi guys, I'm Seckin, co-founder and co-CEO of Cenoa. Cenoa is the dollar account for everyday people in emerging markets. We make it easier and cheaper for people to access dollar and dollar-based products. Technically, it's a non-custodial wallet. Think of us as not as a Swiss Army knife where you can do 100 things, but it's like a simple fork where you can only do dollar-based things and stablecoin-based features. And great to be here.
It's awesome to have everyone here. And as for myself, I'm Eric. I'm part of the Ava Labs business development team, focused on DeFi protocols. So we work hand in hand with most of the protocols in the ecosystem, including all these awesome teams here. So excited for the discussion. Maybe to kick things off about managing DeFi portfolio, before we get into like all the different strategies, how do people actually get access to DeFi? I think you guys, Vector and Yield Yak, you guys approach it in kind of similar ways where they bring in their own wallets, right? But I think we can get the Cenoa approach in a bit.
Yeah, I guess to cover kind of the Yield Yak and Vector kind of onboarding, you essentially need to have your own custodial wallet like MetaMask, Rabby, Core, and you manage that yourself, and you're interacting with our protocols on the blockchain. With you come with what you bring with what you come with. So you need to have a certain level of expertise, I suppose, to be able to set up that wallet, which is a bit different than what Cenoa is doing.
Yeah, sure. As you said, there are different customer segments. There is like a huge DeFi community that has the expertise and that has huge volumes and growing. At the same time, there are millions and billions of people that still don't know how to use DeFi, and some of them actually they are not still comfortable speculating. Like they don't want buy even stocks or crypto assets. They just want to deal with dollars. For example, in our use case, inflation and devaluation is huge in emerging markets, and those people are desperately trying to buy dollars. And products like Core Wallet and MetaMask are great products, but they are a bit more like Swiss Army knife. You can do 100 different things with them. But for a lot of people, they just need a fork. Like they want to buy, hold dollars, and send it to friends and grow. And that's where we come in. We are like a non-custodial wallet, but we make it streamlined and super simple and secure just to hold and buy stable coins. So it's like we are a different level of the stack, but also very much focused on everyday user, which wants simple features.
Awesome. Anything to add, Subnet?
Well, just don't use MetaMask, use Core or Rabby if you're going into the non-custodial way.
Okay, awesome, guys. So let's say the user has now downloaded Core or MetaMask or the Cenoa wallet. At this point, looking at all the different protocols out there, right? How should they be thinking about sources of yield? I know there's like lending protocols, there's AMMs where there's swap fees, there's other more Ponzi-like contraptions out there. So how should users be navigating this, pretty complex ecosystem?
It's a good question. I think that it depends on what your objectives are with your portfolio and probably the size of your portfolio and your risk appetite. So yeah, there's no answer that's going to be applicable to everyone, but you kind of touched on it, like what are the sources of yield, understanding those sources of yield and being comfortable with them is definitely step one. You don't want to be in a situation where, you're just chasing extremely high APRs without understanding kind of where's that coming from. So a good example of really popular strategies recently is GLP. So that's the liquidity provider token for GMX. And the reason that's been attractive is that the narrative recently has been real yield. But there's truth to that because it's being driven by borrowing demand to make leverage trades, which is sustainable because there are traders and people want access to these funds to lever up on their trades, and you can benefit from that. You're taking some risk, you're taking the opposite of the trader risk, so you need to understand that as well. It's not just there's no free lunch these days. There might have been a couple years ago, but so having an understanding of that. GLP yield versus something like a high APR, let's say like a traditional yield farm where a DEX is providing their emissions token to bootstrap liquidity. That's a much different value proposition from a portfolio management perspective. And I don't think there's a right or wrong. There's especially at Yield Yak, we love yield wherever it comes from, but you certainly want to go in with your eyes open of what you're investing in.
I want to add, there are a lot of farms, there are a lot of websites that offer really, really high yield. Not now, but in the past and probably in the future. But you always have to say, if there is a high APR, that means there is a high risk. If it wasn't the case, everyone will go to that farm and the APR will normalize with other APR in the network. So I see a lot of people buying tokens only because they can farm it at 200 APR or I don't know on some protocol. And that's not really a good idea, I think. So I think one important step is you should be comfortable to hold the token even if there was no way of farming it. And then if you are okay with that, you should start to search if there is a way to make yield on that holding that you have.
And I agree with both Smed and Dylan, like optimizing means different things to different people because, as you said, there are different risk appetites and return appetites. In our case, we have seen a huge demand in the market where people just want to minimize the risk and gain a little bit of yield, not maximize the yield because they hold stable coins and they might need it next week for groceries. And the approach we take there is there are a lot of great protocols like Ava, Stargate, Banky, and also other protocols like obviously Yield Yak and Vector Finance. And what we heard a lot from retail customers is they don't want to put all the eggs into one basket, even if it means trading off the yield. Like they accept lower yields, knowing that the basket is diversified across 5 protocols as opposed to 1. And another thing we have heard and implemented is the robo-advisor type of approach. So since they are retail users, they don't want to check their portfolio like multiple times a day, maybe once a week. So they appreciate value-added features where if there's a risk in one protocol, the money can be moved automatically into other, etc. So those are, they are optimizing for minimizing the downside and earn a little bit of yield. And the tricky part in DeFi is to give those value-added features, but not become custodial, because we have seen in 2022 what happens with custodial platforms. And I think the great thing about DeFi and blockchain ecosystem is we have found ways to implement these customer-friendly features, both at wallet level, like password recovery, but also in the smart contract level, implement robo-advisor type features without being custodial. And I mean, it's working well so far.
I think just one thing that's important to add as well is to kind of know like what kind of a DeFi enthusiast are you? You know, do you want a set and forget strategy, or is this something that you want to be actively managing and potentially pivoting on? Like I think a good example is, you know, you could just LP on Aave or a platform like Delta Prime, who I see in the crowd here, and you know, essentially you're earning passively based on real user demand, and you can pretty much set and forget it. But there's other profitable strategies, like you could LP on Liquidity Book, which has been really profitable for some, but it requires true active management because you know you need to rebalance your portfolio, you need to rebalance based on any price movements in the tokens. So I think that's another important layer. Like what's your appetite for engaging with this on a daily basis, weekly basis, monthly basis? You know, it sounds like you know there's different products for each. And that's a great thing because you know the DeFi ecosystem has you know something for everyone.
Yeah, that's really good insights, guys. I remember during the height of the bull, like all everyone cared about was the yields. You know, 10,000% yields. That was considered pretty low, you know, back in 2021. But I guess like these days, as everyone's like looking to conserve more capital, looking to be more selective, right, in terms of where they invest their cash. What is the potential, you know, downside or risk of using some of these DeFi protocols? I think you mentioned the Coady book a little bit, so maybe that's a good place to start, and then we can talk about some other types of protocols as well.
Yeah, sure. I mean, so you know, a protocol like concentrated liquidity. So Liquidity Book, I guess, is I guess gets the most attention on Avalanche. Yeah, essentially, you know, you're taking the liquidity provider position, offering that liquidity, and the cost of that, I guess, is impermanent loss, which is just essentially you might end up with more of one token than the other. So let's say you were maybe a bit green and you just thought, oh, like I see this, you know, 400% APR on AVAX USDC on Trader Joe. You know, I'm going to put, you know, 1,000 USDC and $1,000 worth of AVAX in there, and then you know the price moves $2, and then you have all AVAX or all USDC, and you've missed that upward price movement or been hurt by that downward price movement. So it's just really about it. You know, that's not a bad thing. That doesn't, you know, the protocol is doing what it's meant to do. It's more just about you know understanding the consequences and understanding kind of what you're signing up for. And you know, it's a really nuanced. These are really becoming much more nuanced products than the old kind of traditional yield farms of the past, where you know there was some impermanent loss, but ultimately it was a bit more of a free lunch of just you know these emission tokens that had you know were realistically you know overvalued at the time, and you know there's a lot of I guess mercenary farming, and you know projects are evolving to be smarter so that they're encouraging actual organic activity, people that are bringing value to the protocol and can take part in the upside without it just being such a transactional mercenary ecosystem. So it's progress. It's a good thing, but it means that it's becoming a bit more complex, which I think is why you know platforms like what Cenoa is doing, you know, certainly have their space or their place for people that don't want to dive that deep into the ecosystem, because it is pretty complex.
It is pretty complex, and it like for concentrated liquidity, you cannot just come and put your liquidity and say, okay, I'll come back in 1 week and see you. It's kind of, you need some skills of market making, which is really another subset of skills. And yeah, the products are complexifying, so the strategies must be complexified. Also, there are some protocols that try to build some vaults on their concentrated liquidity pools, but that's not easy. There is some high risks of losing money. And yeah, that's some kind of risk. But you said what are the other risks also? You have to know there are some smart contract risks. if there is a bug in the smart contract or a problem, you may end up losing some funds. So always make sure to check if there has been an audit, but a good audit, because sometimes audits are not sufficient in nowadays. And yeah, of course, always when you're dealing with wrapped assets, make sure to understand where is the unwrapped asset and how secure it is, because you may end up losing your asset if there is a problem on the safeguarding of the base asset.
And to add to you guys, one risk I see is concentration risk, because DeFi is new. It's been only like 3 years, and most of the yield is coming from leverage/margin lending plus emissions. I come from a traditional finance background, and there are like 100 different sources of yield, so it's diversified. DeFi had an amazing 3-year period, but what we are more excited is more use cases, more sources of yield is coming to the DeFi ecosystem, like real-world lending platforms to corporates, SMEs, consumers even, and tokenized US treasuries, like tokenized bonds. And we are bringing more people, like retail users, but also real-world borrowers. I think that's going to make the DeFi ecosystem more robust and bigger, because one of the things we tell our fintech partners, go-to-market partners, is we want to bring the next billion people to DeFi. And the question they ask is, there are only a couple of hedge funds borrowing from those pools. Like, how can you give yield to billions of users? I think the next cycle is going to be even more exciting with more use cases, more sources of yield coming online, and we are super excited about that. And we are always coming to these conferences, especially to find the new fiat on-ramps, the new lenders, the projects who are tokenizing treasuries and bonds and other things like that. So I think the next few years is going to be more exciting, and it will have less concentration risk.
Yeah, I definitely agree.
Yeah, I was just going to say one more thing on kind of the overall portfolio management, and that's that you kind of need to have some conviction. And one thing, that I've learned the hard way is that, there's so much like white noise and there's so many distractions on crypto Twitter. The amount of times I've aped into something, then seen like a random tweet and then like sold it on the first red wick, and then, it's so easy to make mistakes and fumble your bag that what has worked for me to a certain degree is, really does help to kind of manage, to embed a bit into the things that you're investing in. So, I'm pretty familiar with the Avalanche ecosystem. A lot of my portfolio is allocated to that because I have a pretty close finger on the pulse. I have less of a finger on the pulse on, some random project on another ecosystem that I don't have the time to do a lot of research into and to really kind of, embed in the community. And by investing in things I'm more deeply embedded in, you see potential red flags. There's always tons of alpha in plain sight. The counter to that is you don't want to get caught into like an echo chamber, an echo bubble where you just become like a blind maxi and like, oh, this community is like, of course this is going to be successful. You need to have a certain amount of perspective, and you want to be open-minded and try to find a balance there. But yeah, I think having a certain level of conviction, like if you're going to take this seriously, makes a huge difference.
Yeah, well said. And I think a lot of it really does come from just personal experience, right? A lot of people in DeFi, they'll lose money before they start, generating yield. So it's important to keep that in mind. And I think we've done a good job of covering the high level. Maybe we can get into some of the juicy stuff. So maybe starting from Seckin with you, maybe we can go through a few examples of different types of yield strategies on Avalanche that people in the audience today, right, can get into, and then maybe we can go down the line and go into more aggressive strategies, let's say.
Yeah, of course. As you said, there is a spectrum within the team. Like we launch a new contract every 90 days with different logic, because it has to be immutable, it has to be non-custodial. So once we launch it, we cannot touch the logic, but we refresh every 3 months. So we brainstorm a lot of strategies, but in our case is I'm the boring person on the table. Like we use only USDC as stablecoin. We don't even touch Tether and others. That means we cannot even LP in a lot of the DEXs. We just use lending pools. That's because we talk to our customers and they want the simplest strategy with lowest risk. Like for example, the strategy we use right now is we give risk ratings to protocols like Ava, Bank, Stargate. They're all great, but they are not all at the same level. And we rate stable coins every 3 months, and right now we only use USDC. And the logic is manages the money in a risk-weighted way, which means it goes mostly to Ava, but depends on the TVLs. It's correlated with the yield offered, the TVL, and the risk rating of the protocol. Like right now, I think we are 70% Ava, 20% Stargate, 10% Banky, I think, but it changes day to day based on the metrics. But our plan is, as we get more customers and as we educate our customers more, they will become less retail and more DeFi native, and hopefully we will also offer products, more sophisticated logics. We will probably integrate with Yield Yak and Vector. They will feel more comfortable with more stable coins, more assets, more protocols. But right now we go with the simplest and relatively lowest risk strategies.
Yeah, so I guess kind of the more interesting stuff happening in the ecosystem right now. I guess step one, I would suggest you should be engaging with a liquid staking derivative if you're taking any kind of longer term position on AVAX. You're just kind of giving up that 7% yield if you're just kind of holding AVAX spot. So S-AVAX from Benki, it's a really good one. Yield Yak has one, YY AVAX as well. But in terms of kind of the stuff that's a bit more complex, a bit more fun, I think the one that I have to plug is a Delta Prime strategy that Avalanche Rush has been supporting, and that uses a Yield Yak's yield-bearing GLP token, and basically that just lets you lever up to 5x on your GLP position. So it's really clever. You can deposit a blue chip asset, USDC, USDT, Ethereum, BTC.B, and then you can borrow up to 5x from any of those tokens. And you actually, there's some really nice nuance there. If you want, depending on what you borrow and then swap into GLP, you can take a long or short position on the market. So for example, if I borrow USDC and I buy GLP, I'm taking a long position, because ultimately GLP has 50% exposure to crypto. But if I borrow AVAX and I swap that into GLP, I'm taking more of a short position on the market because I'm essentially swapping half of that AVAX into stable coins. But then I'm earning 5x leverage on GLP. GLP historically has been earning about 30% yield. So I can be earning up to 120, 150% APY, depending on my risk appetite, with a relatively low risk strategy. So obviously this is pretty advanced DeFi stuff, but yeah, that's the type. I guess this is the opposite end of the spectrum of earning 5% on USDC. You can take it all the way to the other end, which this is, which is more kind of a Yield Yak and Vectors area. But yeah, I'd say that's one of the juiciest things happening in the ecosystem right now.
Yeah, I totally agree. Delta Prime is really a good product. Here at Vector, we're really on the safe side. We don't want to do some complex strategies. We don't want to gamble our users' money. So in our website, you won't find some degen strategies, but if you feel comfortable in market making, I think that providing liquidity on liquidity book right now can be really, really, really generating a lot of yield, but there's some risk. So you should make some research on how the underlying product works. And yeah, other than that, I'm not really degen, so
it's a developer's answer right there. This is the marketing guys, so yeah.
So good. So I guess maybe a last question to wrap things up. So we talk a lot about making DeFi accessible, right, to the masses. I think in all of crypto, there's probably like a couple million daily active users. Like we're still very early. So how do we onboard the next billion to DeFi? Is it a matter of access? Is it a matter of UX? What do you think are the major pain points today, and how do we kind of address that going forward?
Yeah, I think UX is one of the major pain points. Like now, when a user wants to go in a decentralized way, he have to handle multiple blockchains. He have to know which are the websites that offer a sustainable yield or just offer yield. There are a lot of unknowns and not really a website that will centralize all of that. We have some cool stuff like DeFi, for example, which can give you a lot of source. But even with that, you have to bridge from one blockchain to another, wait for the money to come. I think what will really help our world evolve is having one centralized platform where a user don't even know which blockchain he is using. He just use the blockchain technology as a whole, and all the underlying technical aspects are handled by the protocol, but the user didn't even know what are the steps done to achieve his goal. So that's something I kind of want to build, but that's a lot of work.
I think for me, it's security. It still is pretty challenging if you're like telling your friend, like, yeah, create your own wallet and, make sure to have your seed phrase in cold storage and like buried in your backyard, and you need a ledger, and if you lose your ledger, you need to go dig that up, and if you use a hot wallet, you deserve it if you get hacked. It's like that stuff probably frustrates me the most, and I think we still have the longest way to go to because it is risky if you're not taking these steps, and beyond just the smart contract risk, the self-custody part is intimidating. I find it intimidating sometimes, and I've been around for a long time, so there's a lot of progress being made, but I think that's the biggest thing that prevents me from telling all my friends to jump into Yield Yak, but hopefully we're getting better.
Yeah, I agree. And the number one thing a new technology needs to get adopted by a billion people is always a killer use case. Like, it needs to solve a huge and real problem because people essentially, they're interacting with hundreds of brands a day, hundreds of products a day, and 99% of retail people, they don't want to do it out of curiosity, so it needs to solve a real problem. And there will be, I think, many use cases and problems DeFi will solve in the next 10 years. And I think one of the biggest candidates is inflationary countries, because DeFi and blockchain essentially gives a completely new financial system. And if you are living in robust countries, that may be a relatively nice to have type of thing, but there are countries that do not have a great financial system, they do not have good currencies, etc. So I think one of the big sources will be people who live in emerging markets and inflationary ecosystem that they are completely unhappy with what they have, so they have the motivation to try out new things, take some risks, etc. So we are excited to give a solution to those guys.
Yeah, definitely. And excited for everyone kind of being at the forefront here of all this innovation. So maybe to wrap things up, is there any last words you guys like to say for the audience? Anything you guys want to promote in terms of new features or products coming out? Floor is yours, guys.
Yeah, I mean, I think things are changing still pretty quickly, and there's a lot of new projects that I'm excited about that are launching on Avalanche soon. Some new dexes, and it's exciting that there's still a lot of kind of innovation happening despite the market trends. So there's a lot to be excited about, and we're happy to be here.
Yeah, we are launching a couple of new countries like Nigeria, Kenya, Ghana, Egypt, Pakistan, and Argentina, as well as money transfer and Android features. So if there is anyone building a fiat on-ramp, off-ramp, custodial or peer-to-peer, please find us. I think one of the biggest barriers of access in those countries is basically easy ways to deposit and withdraw money. So always happy to connect with people who do that.
Well, just want to say thank you for being here. I'm happy to who have been here. And for news and vector, I can't really say anything right now, but follow us and you'll see.
Yeah, awesome. Thank you, guys. Everyone give it up to our panelists.
Thank you, Eric.